Hello, I'm Ali, and in this video we'll talk about audit assertions. It is the responsibility of those charged with governance to make sure that the financial report gives a true and fair view of the entity and its operations. When financial statements are prepared, management makes assertions about each transaction class, account balance, as well as the way the items are presented and disclosed. So what is assertion? Assertion is a statement made by management regarding the recognition, measurement, presentation, and disclosures of items included in the financial report. For example, when reporting on inventory, management of the entity should make sure that the items disclosed exist, are owned by the entity, represent a complete list of the inventory owned, and are valued properly. Another example is when management is reporting on sales. Management should ensure that the amount disclosed represents sales of the entity that occurred during the accounting period. They should also ensure that sales are recorded at the correct amount, represent a complete list of all sales, and are classified correctly. Australian Accounting Standard ACCA 315 requires that auditors use assertions for transactions, account balances, and presentation and disclosures when assessing the risk of material misstatement in financial report and when designing their audit procedures. This means that auditors need to gather sufficient appropriate evidence about each assertion for each transaction class, account balance, as well as for presentation and disclosure. Management's financial statement assertions are both explicit and implicit. ACCA 315 defines these financial statement assertions under three categories. The first category is assertion about classes of transactions and events, such as purchases and sales for an accounting period. This figure shows the assertions used for transactions and events for an accounting period. The first one is occurrence. When auditor tests for this assertion, auditor searches for evidence to make sure that a recorded transaction or event such as sales or revenue or expense items took place and relate to the entity. This assertion is important when the auditor believes that there is a risk of overstatement, or you can say that some transactions and events are recorded but did not actually occur. For example, fixture sales can be recorded by management to overstate revenue and profits so they can meet their targets. When testing for completeness, auditor searches for transactions or events and makes sure that these have been recorded. This assertion is important when the auditor believes that there is a risk of understatement and that some transactions or events that should have been recorded have not been recorded. For example, expense accounts are always at risk of understatement, such as advertisement expense incurred but not recorded to understate expenses and overstate profit. When testing for accuracy, an auditor searches for evidence that transactions and events have been recorded at appropriate amounts. This assertion is important when the auditor believes that there is a risk that reported amounts are not accurate. For example, when a client has complex discounting system where error can easily occur. When testing for cutoff, an auditor searches for evidence that transactions have been recorded in the correct accounting period. This assertion is important for transactions occurring close to year end. For example, a client may record a sale before year end, whereas it has occurred after year end. When testing for classification, an auditor ensures that transactions and events have been recorded in the proper account. This assertion is important for material accounts. The second category of assertion is account balances, such as assets and liabilities in the balance sheet. This figure shows the list of assertions used when testing balance sheet items. The first one is existence. When testing for existence, an auditor searches for evidence to verify the assets, liabilities, and equity items included in the balance that appear in the financial report actually exist. This assertion is important when the auditor believes that there is a risk of overstatement, for example, in inventory. When testing for rights and obligation, an auditor searches for evidence to verify that recorded assets are owned by the entity and that recorded liabilities represent obligations of the entity. This assertion is different to existence assertion which I just discussed, because as the assets and liabilities may exist but not owned by the entity. For example, an inventory on consignment which is recorded as an asset of the entity. This inventory physically exists but does not satisfy the rights and obligations assertion, as this inventory is not owned by the entity. When testing for completeness, an auditor searches for assets, liabilities, and equity items and ensures that they have been recorded. This assertion is important when the auditor believes that there is a risk of understatement and the client has omitted some items from the balance sheet. For example, an auditor will search for unrecorded liabilities such as loans. When testing for valuation and allocation, the auditor searches for evidence that assets, liabilities, and equity items have been recorded at an appropriate amount and allocated to the correct general ledger accounts. This assertion is important when the auditor believes that there is a risk of over or undervaluation. For example, an auditor checks that inventory has been appropriately recorded at the lower of cost and net realizable value, as there is a risk of overstatement. Another example is an auditor tests for the adequacy of the allowance for doubtful debts provision, as there is a risk of understatement. The third category of assertions is how items are presented and disclosed in the financial statements. This figure shows the list of assertions for presentation and disclosure. An auditor ensures that all items included in the financial report are presented and disclosed appropriately. They check that disclosed items represent events and transactions that occurred for the entity, are recorded at appropriate amounts, and are described accurately. An auditor searches to ensure that all items that should have been disclosed are included in the financial report. Please note that presentation and disclosure assertion relates to the disclosures themselves, not the underlying assets and liabilities, revenue or expense items. For example, classification and understandability, which is one of the presentation and disclosure assertions, relates to the classification of the disclosure, not whether the correct account was used for the transaction, class, or event. And in the next video, we'll talk about audit evidence. Thank you.